Yeah. Good morning, everyone. It is my pleasure to welcome you all to the Valuation Manthan webinar session 21, hosted by Institute of Chartered Accountants of India. I am C. Astagulati and I will be serving as the moderator for this session. So today, chairman may not able to join the meeting, and our vice chairman will later join the meeting. And today we have Harmanjeet sir with us. So now I'm delighted to introduce our esteemed faculty for today's webinar, CA Harmanjeet Singh, with over 13 years of diverse experience in finance, audit, and corporate affairs. Holding a BCom from Punjab University and certified by ICI, he is also an insolvency professional and a register valuer for securities and financial assets. His expertise spans taxation, contracts, acquisitions, and valuation for listed and non-listed companies. With a proven track record in project implementation and regulatory compliance, he is a dynamic leader who brings deep industry knowledge. Please join me in extending a warm welcome to CA Harmanjeet Singh, sir. Welcome, sir.
Good morning, everybody. There's a little bit of correction I have to make. I have done my BCom from the Punjab University, not Punjab University.
Oh, sorry.
And I really wanted to thanks ICI, ICI RBO, ICI Valuation Standard Board for giving me an opportunity to give a lecture on the Binomial option pricing. I wanted to thank Shri C. Hansraj Tulji, Chairman of Valuation Standard Board. I wanted to thank Vice Chairman Shrimati Priti Savlaji for giving an opportunity. I wanted to thank both the coordinator, Shrimati C.A. Asta Gulati ji and Shri C.A. Rahul Ehwal ji. So, before starting the lecture on the binomial option, a simple question comes to the mind. What is option basically? Whether option is related to only to the stock market or an option can be exercised to any other assets as well. So, try to understand the basics of options. Why option is needed? As everyone knows, there are two types of options. First is call option, second is put option. Let me first share the screen presentation. Option is nothing refer to a financial instrument that is based on the value of a specified assets or security, normally which is stocks or shares. However, it can be related to any other assets as well. Take an example of land, take an example of any assets, gold, any assets. You can you can create a contract of option. Option is nothing but a contract to buy or contract to sell of a particular asset within a particular specified time. So let's start with the call option first. There are two type of options. First is call option, where second is put option. As any contract, there are two person involved. One is a buyer and other is a seller. Seller is normally known as a striker of the option. So what is call option? Leave the definitions, leave the theory, leave everything. What is known as a call option? Call option is nothing but a option to buy a particular asset on or before expiration of a specific time. Take an example, me and say Mr. Rahul Ehwal come under a contract. Mr. Rahul Ehwal has a land. We both come under a contract that after a specific period of time, I will buy this land with a specified amount, whatever the amount at that time of the land, but I will buy on for a specified price. But I have an option to buy the land from the Mr. Rahul Ehwal, or whether I have an option and also have an option not to buy a land from the Mr. Rahul Ehwal. So in that case, Mr. Rahul Ehwal will ask me, sir, you have to give me some security that you will definitely buy a land from me only. or you will not buy land from me only, but I need a security. That security is nothing but a premium which I have to pay to bound the contract with Mr. Rahul Ahmed, that I will buy the land. So on a specified date, what is happen? Suppose the price of the land, market price of the land is much higher than the price which I have made a contract with Mr. Rahul. Now what I will do? I will simply exercise the option and ask Mr. Rahul that Mr. Rahul give me the land as we have already come under a contract. Is it clear? But suppose the market price of the land is cheaper than the strike price which we made a contract with Mr. Rahul, that I will buy land from Mr. Rahul or I will buy from the market. Obviously, I will buy the land from the market and I will not exercise the option. But the only loss which I have to bear is nothing but the premium which I have already paid to Mr. Rahul. So in call option, the call striker has an unlimited potential of loss. Unlimited potential. Why? Because suppose whatever the market price at that time, but Mr. Rahul has to pay me the land at a specific price which we made a contract before. But being a buyer of the call option, what is my loss? My loss is nothing but the premium which I have already paid to Mr. Rahul. Same is applicable to the share price. We made a contract of a call option that I will buy a specific price of share at a strike price, whatever the price is this. If the price go up, the buyer of the call option is in profit, and if the price go down, the buyer of the call option will not exercise the option, and only loss is the premium which he has already paid. It is a speculative transaction based on speculation. Now, I think everybody clear about the call option. Let's move forward. Now, understand the put option. Put option is my right to sell a specified asset to someone. Normally, we trade it in share and use this transaction as put as that we have come a derivative transaction or known as put option with a stakeholder of put option. But if I tell you that all of us, whoever is watching this video, all the ICI member, most of the people of India have already exercised the put option. You may ask, sir, I am not dealing with the shares. I never deal with the shares. So how can you say that I have a contract of put option with me? See, understand what is put option. We all have four-wheelers, we all have two-wheelers, and we come a contract with the insurance company. That the insurance company say, sir, give me the premium, I give you the insurance, that within a specific period of time, whatever the price of your asset which you have come insured, I will buy from you this specific price. Isn't it? Suppose I have a two-wheeler and I have an insurance of the two-wheeler. What insurance company will do? Till the price of the insurance and the price of my car is above than the strike price, I will not exercise the option. But suppose my car met with an accident, hugely damaged, and suddenly the price of the car come below the market price. What I will do? I will go to the insurance company and say, sir, we have a contract. Take this car and give me the price, strike price, which we had come under the contract. This is what a put option. Simply exercise to sell at a specified price, on or before. I will discuss on or difference between on or before in later slides. But the fundamental of call option and the fundamental of put option should be clear before going to the binomial. I hope everybody got what is put option and what is call option. You understand? Most of the valuer using the call option while calculating the ESOP pay. Employee stock option plan, we use binomial while calculating the SO. And normally in India and Indian market scenario, we are using the European option. What is your difference between European and American option? Not much, not much. What European options say? Whether it is call option or put option. To the stakeholder, I will say, sir, come to a contract and I will exercise the option on a specified period or specified date. Not before, not after, but on a specified date. That is European option. Mostly in India, the European option contract come on the last Thursday of a month. And what is American option? American option that in a specific period of time, it is whenever I am in the money or I want to exercise the option, I will exercise the option. I give you example of insurance company. That is a perfect example of a American option. That whenever between the period of time my asset value decreases, I will exercise the option. Is it clear? My difference between the American option, difference between the European option. I will teach you both the binomial with the scenario of American and with the scenario of European. Before going to the binomial, we need to be clear about certain definitions. These definition will help every valuer while valuing the option, whether it is binomial or Black-Scholes or Monte Carlo. What is add the money? Add the money, suppose the strike price is 100, the market price is also 100. When the European, I will give you the example with the baseline of European option. Suppose at the end of the period, my strike price is same as the value of contract. So I am neither at the profit, I am neither at the loss. And suppose my premium is 0. So I'm neither at the profit and neither at the loss. I'm at the money. Whether I will exercise the option or I will not exercise the option, it makes no difference. Clear? At the money. In the money, obviously, when I am in profit, the call option give me the profit or a put option give me the profit. I'm in the money. There is a money in my bucket which I get while exercising the option, whether call or put option. Suppose in call option, the strike price is 100 and the market price is 110. So I am in the money of 10 rupees. Okay. And next example is out of the money. Out of the money when there is no use of getting utilizing the option. How? Suppose the strike price is 100 while in the call option and the market price is 95. It is not beneficial to buy from the call holder. I will buy from the market at 95. So I will not access the option. So I am out of money of the option. So at the money, in the money, out of the money. These three definitions will help you understanding clearly the binomial in the next slides. See what is strike price? Strike price is nothing. The with the contract is made that I will buy this asset at a specific price or I will sell this asset as a special price is a strike price. What is underlying asset? Underlying asset is can be anything, whether it is gold, whether it is land, whether it is shares, whether it's anything. But mostly we deal with binomial in shares. More specifically in while valuing the ESOP valuations. What is implied volatility? See, volatility is something which is a which we have to use from the historical point of view. That how the our share is quickly move whether up or down on a within a specific period. That is a volatility. I will teach you how to calculate the volatility with a simple formula. There are many formula, but I will give you the simplest one, which is also available with us on the ICA RBO site as well. So come to the binomial. Binomial, as the name suggests, binomial. I means two. Binomial give me the two chances whether my share can be go upward at a given point of time or downward at a given point of time. While going the upward, it can be go one movement upward, not two movement upward. So say 180, no, only one movement upward and one movement downward. So it give me the binomial tree of using two nodes. I will show you the binomial tree in next slide. So it using the iterative approach. Iterative means cyclical or seasonal approach. Binomial move from one node to second other node within a specific after a specified period of time. What is a specified period of time is depend upon the case to case basis. But the whole time period shall be considered using a yearly approach, not monthly approach, not by 6 monthly approach, not daily, but yearly model. I will teach you how to use that changes in time or delta time. It give me the two possible outcomes. See, it is a drawback of a binomial or it is a precondition of a binomial. That binomial use the same probability of going upward or downward on at each every node while creating a binomial tree. It is not the case that at a one node I am different probability can use the different probability or in second node I can use the different probability. No, I have to use the same probability at different nodes. How to calculate the probability, how to calculate the up movement, how to calculate the down movement. I will teach you all of these things based on the most scientific methods. Let's give me the simplest binomial with a one node. With the example. Start with an example of one node binomial. Suppose the current market price of a share or an asset is rupees 100. And I come with a contract with a call striker, whether it is 115 strike price, 110 strike price, 105 strike price, or 85 strike price. These are for different strike price. You will know what is the value of a binomial at different strike price. In 1 month, whether my stock can move upward of 10 rupees or downward of 10 rupees. So after 1 month, the market price of my share can be 110 or 90. Not in between, not anything else, specifically 110 and 90. Suppose the premium is nil and the ratio of going up movement and ratio of going down is 50-50. It is an assumption in this exam. So what will be the my price of the option or value of the option of my profit, whatever the term you can use. If the strike price is 115, see understand the market price at this node is 110, my strike price is 115, whether I will exercise the call option or not. Simple question you have to ask while exercise the call option, whether I will buy from the market or I will buy from the call seller. And while exercise the put option, simple question you have to ask from yourself whether I will sell in the market or I will sell to the put seller. In which case I will get the profit, I will use that option. In this case, I can buy from the market at 110 or I can buy from the call striker at 115. I will not buy from the call striker. I will buy from the market. It give me the profit. It is beneficial to me. So T1 with the strike for 115, I will not exercise the option. So the value of option at this node is 0. Understand? Now come to the node 2. Same. Market price 90. Contract price is 115. I will not exercise the option. I will buy from the market. So at this node, the price is also 0. So I have to come here. What I will do, there is a 50% of chances going upward, 50% of chances going downward. Or I can also say there is a 50% of chances going backward also, and 50% chances here. So zero price at this node come back to this zero, chances of zero is 50%. So zero multiplied by 0.5 or 50% is also zero, plus zero multiply at this node the value of option also zero. See, in both cases I am out of the money. So zero multiplied by 50% at this node plus zero multiplied by 50% at this node is zero. So the my current market price of the call option is zero. Understand? I will skip this 110. I will directly come to the 105. Since in the case if the price of my call option strike price is 105, now the situation changes. Now at this node, what is the whether I will buy from the market at 110 or I will buy from the call seller at 105. Obviously, I will buy from the call seller. I'm in the money of rupees 5 rupees. So the value of the option at this particular node is 5 rupees. Okay. And value of the option at this node, whether I will buy from the market at 90 rupees or I will use the option and buy from the call seller at 105. Obviously, I will buy from the market at 90 rupees. I will not access the option at this node. So the profit or the value of call option at this node is nil or zero. However, the value of call option here is 5 rupees. If the strike price is 105. But the chances of this node is 50%. So I have to further discount it to 50% while coming to this. So as on today, the value of this node is 2.5 rupees, and as on today, the value of this node is 0. 0 multiplied by 50 is also 0. So the value of call option with the strike price of 105 using the binomial option is 2.5 rupees. However, I have to further discount it with a risk-free discount rate. We will discuss later, but for the basic understanding how binomial work, you have to understand that the with the strike price 105, my call option value is 2.5 rupees as on today. So come to this example with 100 rupees. Again, at this node, I'm in the money of 10 rupees, and at this node, I am out of the money. Out of the money, I will access the option the value of 0. So at this price, 10 rupees multiplied by 50%, that is 5 rupees. 0 multiplied by 50%, that is 0. So the my current value of option is 5 rupees. However, come to this example. In this example, the strike price is 85 rupees. So what it changes? I'm in the money in both of the options, in both of the node. At this node, I'm in the money of 110 minus 85, that is 25 rupees, and I'm in the money of 90 minus 85, that is 5 rupees. I will exercise the option at this node as well because the market price is 90 rupees, and the my contract value is 85 rupees. So I am in the money of 5 rupees. However, I have to calculate the call option value as on date. So I have to come back to this node. 25, 50% chances, 12.5 rupees, 5 rupees, 50% chances, 2.5 rupees. So my value of call option using the binomial theorem is nothing but 15 rupees. 12.5 plus 5. Understand? Easy to understand binomial. Binomial is the most easiest form of option in my view. So come to while calculating the binomial, we need certain inputs. What are those inputs? Current market price or strike price, second is strike price. Then I have to see in how what is the total number of periods in term of year, I can exercise the option, and after how many iteration I have to use the binomial. So it give me the time intervals. Time interval is nothing but suppose my total time to maturity is 1 year, and I'm using the iteration of 3 months. So 12 months divided by 3 months is my number of intervals. I will get the four number of intervals. See, again, I am telling you that time to maturity is always calculated in terms of years. If my total number of years is 2 years and I'm using the number of iteration is say 3 months, so my total time interval become 8. 24 divided by 3 is equal to 8. Again, if it is 6 months, it become 2. I need beforehand volatility or standard deviation, or very rarely there is a chances of dividend. However, it is a prerequisite of a calculating the binomial theorem. There is certain parameters which I have to calculate. See, and before understanding the binomial, I am telling you how binomial works. Binomial works in a perfect way. That in a perfect world, what is happening? I can only get a risk-free return. It is assumption of binomial. It is also limitation of that. That I can. It is a perfect world. In a perfect world, what I will get? I will get nothing but a risk-free rate of return, and my growth shall become risk-free growth rate. Nothing. Understand? So how I will calculate the growth rate? For the using of binomial, I have to go to a mathematical formula which we have tried from the calculus or physics. That is a Brownian motion formula. We drive the calculation for the binomial, some part of the Brownian motion. What it say that your growth is directly linked with your time, and you will get the risk-free rate. So within a particular period of time, my growth become only risk-free rate in term of time, and I have to multiply with the random number. I will get I will get the growth rate. So instead of multiply with any random number, we get a formula from using the Brownian uh, motion formula, that e raised to the power r multiply j delta time. So e raised to the power r is nothing but a risk-free return. Changes with the delta time, give me the growth rate. However, my growth rate will be directly hampered if I give any dividend, isn't it? The amount of dividend which I will give will reduce my growth rate with that percentage. So what I will do, I will use change the formula with e raised to the power r minus q multiply delta t. Delta t is number of iteration or changes is time. While using in Excel, I can write in this way in Excel. exp under root of r minus q multiplied by delta. I will show in the Excel utility how to use this formula. So the next point or the next calculation I have to do the up movement and the down movement. Same, I will use a Brownian motion formula. See, for the up movement, what I have in my hand, in parameters, calculating the parameters, what input I have with me. I have nothing else on the volatility. I have volatility with volatility multiply by with the random number, give me the movement. Or instead of using the random number, I will use the Brownian motion. So e raised to the power the standard deviation or the volatility is what is my up movement. isn't it? And that standard deviation multiply with the changes in time, give me the up movement with a particular period of time or with a particular iteration, delta t. Understand? So the formula shall become the up movement is e raised to the power standard deviation by under root of delta t. So while seeing this formula, a question comes to your mind that Mr. Herman, while calculating the while while calculating the risk-free growth rate, you simply multiply with the changes time. You did not take the square root. However, while calculating the up movement, you are square rooting the changes time. See, I understand your point of view, but understand what is standard deviation. Standard deviation is under root of variance, and standard deviation scale with the square root of time. That is why while using the up movement, I am using the under root of time. Understand? Now come to the down movement. Down movement is nothing but 1 divided by up movement. However, there is a formula, but you can skip that because the simple term is 1 divided by. Or you can also use this e raised to the power minus standard deviation multiplied by the under root of delta. You will get the same uh, value or the same figure. Understand? Up movement, down movement. Now third calculation shall be what is the probability of going the up movement and what is the probability of going the down. Before going calculating the parameter, what I told you that binomial work in a perfect world. Okay, so what is my up movement? What is my growth rate become? My growth rate or A shall be the price I will get at the up movement and the price I will get at the down movement. Isn't it? The sum of both is my growth. So up movement multiply by the probability plus down movement multiply by the probability of down movement is my growth rate. Okay, easy to understand? No confusion. What it will give me? It will give me a simple formula of probability. That is growth minus down movement divided by up movement minus down. This is my formula. I will teach you how to use in the Excel utility as well. However, basic should be clear. How binomial work, the basic should be clear. Probability of up movement and probability of down movement. Okay. Now let's start with the practical examples of binomial option. This is my first slide to give you a hint how binomial tree work. In this slide, we will calculate the growth rate and the probability of up movement and the probability of down movement, or probability of up jump or probability of down jump. See, simple to understand. My current stock price is 20 rupees. My strike price or the contract price of the call option, I am using the call option here. It is a European call option. The strike price is 21 rupees and the up jump we are assuming it is 10% up or 10% down. However, we will calculate the up jump and down jump in next slide. But for understanding, I am assuming in this slide that it is a 10% chances of going up. Is up jump is 10% and down jump is also 10%. So simple. You need not to understand, need not to think anything, but simply multiply the up jump with 10% and down jump with 10%. This is a 6-month binomial with 3-month iteration. So 6 months divided by 3 months become 2.5 here and 2.5 here. We are using in term of yearly basis. Understand? So 3 months in is 2.5 and further 3 months is 2.5 is that is 0.5. I am skipping the volatility because volatility is required while calculating the up jump and the down jump. And assuming the risk-free rate that is 12% and also assuming that there is not. So what is happening here? What I have to calculate first? I will calculate the growth rate first. See parameters. I will calculate the growth rate first. What is my growth rate? Risk-free growth rate is e raised to the power r multiplied by changes in time, or e raised to the power r minus q with the respect of the changes in time. What it gives me? Look, e raised to the power risk-free rate 12% minus dividend 0 with the changes in time, it comes to 1.030. Okay. And further, I have to calculate the discount factor as well. See, discount binomial is what? Forward correlation and backward induction. While going to the backward, what I have to see, is there any discount factor or is there discounting in my returns? Yes, I have to calculate that as well. For that, the formula is nothing but e raised to the power minus risk-free rate multiply the changes in time, or exp minus c9 multiply by further the period of time, or changes in time, or delta t. Now come to the value of option. First, I have to calculate the price of my shares at each node. At 0 node or as on date, my price is $20. So after 10% of up movement, my price shall become $22 at this node, and a down movement of 10%, my price shall become $18. I will teach you the two-step binomial. However, after understanding this, you can calculate n number of binomial with simple paper and pen. So after this node, what is happening? My growth is constant, by up movement is constant. This is a limitation and assumption of binomial. So $22 further 10% increase is $24.2 at this node, and down percent decrease, 10% decrease, that is $19.8 at this. And I have to calculate each node separately. At this node, a 10% up movement is $19.8 and 10% down movement, that is $16.2. Understand? No confusion? Now what I have to do here? I simply ask one simple question at each node. Whether I am in the money or I am out of them. At the money also consider out of them. So at each node, ask yourself a simple question. See whether I will buy from the market because it's call option, or I will use the contract at $21. At this node, whether I will buy at $24.2 or I will exercise the option at $21. Obviously, I will exercise the option. The price is less. Or can I also do one tricky thing that I will buy from the this and sell from to the market at $4.2. I can do that because I have a contract to buy. So what it will give me? It will give me a profit of $3.2 while exercise the option, because I can sell to the market with a profit of $3.2 at this node. So come to the second node, ask yourself same question. Whether I will buy from the market or I will buy from the striker. At this time, I will not buy from the gold striker because the market price is less than what the contract value is. Easy to understand? No confusion, I think. The call option I will not exercise. I am out of the money. The option value is zero. Now come to this node. Again, I am out of the money. The market price is cheaper than the contract value. So the price of this option is zero. Understand? This is an example of a European option. In European option, I told you that I can only and only exercise the option at the end of the period or at the end of the maturity, whatever it is. Understand? So forward correlation has done. Now I have to come to the backward. I have to do the backward induction to as on date what is the value of my stock or what is the profit I will get right now. See, my value of call is $3.2. This node is made. This node is made from possible outcomes, up movement and down movement. So $3.2, the probability of getting the $3.2 from this 5, yes, and probability of getting this is 34.77%, isn't it? Yes. So this multiplied by 65.23% plus this multiplied by 34.77%, further discounted with the discount factor, I will get the value in hand at this node. Understand? This multiply the probability, this multiply the probability, the sum of both further discount with the discount factor, that is we have calculated here. We get the value of the option at this node. But I have to come as on date, I have to come to this node, not the value of option is this is a future value. I have to come to the value in hand right now. So this node is made from two different nodes. So I have to calculate the value of option at this node as well. Yes. So how will calculate the value of this node as well? Simple. The probability of up jump, the probability of down jump, and the value at different probability further discounted with the discount factor. Strangely, we have zero value of up jump, zero value of down jump. Whatever the multiplication I will do, the value will remain same, that is zero at this node. Understand? So in the European option, I will not calculate different value whether I am in profit at this share price or not, because I have the power or I can use only at the expiration of the period the option. So what I will assume that value of option is $2.03 and value of this node is $0. So I have to further discount it to this node as well. Simple. The probability of jump is 65.23, 2.03 multiplied by 65.23 and 0 multiplied by 34.77. The sum of both, further discount with a discount factor, I will get the value of call option as on date. See, look how simple is it? How simple binomial we can use with a simple pen and paper when we don't need a Excel formula if the fundamentals are clear. This is for your understanding purpose how the binomial works. This way as well. The stock price at different nodes and the option price at different nodes. This shall be easy to understand. Value is same, but the presentation is different. So in this slide, what I will teach you the calculation of up jump and the calculation of down jump. But for that, I required volatility in my hand. It is a prerequisite or the parameters. See, for calculation of volatility, there are various methods of calculation of volatility, but the simplest way of method I will teach you. See, mostly while calculating the ESOP, our companies are a non-listed company or a pre-listed company in most of the cases. So what you have to do, I have to use the historical volatility of a comparable company. We can take a number of comparable companies, whatever the most scientific, using the scientific formula or rationalism. So here I will teach you using the three comparable companies. Comparable company one, comparable company two, comparable company three. What I will do, or what we all do, we will do the see the changes in share price. Here I am using the changes in share price on weekly basis. Okay, and simply do the logarithm log of the changes in share price. It is a mathematical formula. The detailed discussion take much time, but for the easy understanding, we will take the log of changes time at each moment. Mostly, or simply we have to take minimum 3 period, which is required. But however, you can take maximum period or further extended period. Here I take 10 years period. It gives me the standard deviation of the logarithm or the volatility of the weekly basis. Understand? Easy to understand. Nothing else. The formula is standard deviation of the whole logarithmic value. What it will give. I get the volatility, but there is a catch in this volatility. This volatility is weekly basis. But using the binomial, the time period which I am using is yearly basis. So I have to convert this weekly volatility into a yearly volatility. Simple. There are 52 week in a year. I will simply multiply with the square root of 52. Understand? Easy to understand. But what if I take the daily volatility or daily standard deviation? See, it is a set rule that mostly there is a 252 days in a year when the stock price or the our share market is alive. So while daily using, if the volatility is on daily basis, I will use the square root of 252 instead of 365. Take care of this. The value should take care of this. Say the comparable company one, comparable company two, the same rule I will apply to comparable and comparable company one. The same rule I will apply with the comparable company. Easy to understand? Okay. So there can be uncomparable companies. Whatever the comparable company, I will simply do the average volatility of all the comparable companies. It is a historical volatility what I will get. We will use it. We can use it. This volatility working is also accessible with the ICIR. So member of ICIR view can also take this calculator from there as well. Volatility is clear. Every parameter in hand. Now come to the calculation of the up jump. What, what is the formula of up jump? E raised to the power the standard deviation multiply under root of changes in time or delta t. For the calculation of jump up, we have only standard deviation with us. And the standard deviation scale with the square root of time, which I have already told you. So here the up jump is e raised to the power volatility multiply under root of delta t. What I am getting is 1.6. Okay. And a down movement is simple 1 divided by up jump, or there's a formula e raised to the power minus standard deviation multiply by under root of delta t. Again, now come to the practical point of view. Easy to understand. We have the up jump, we have the down jump, we have all the parameter, we have all the input. We can use the call option or we can convert it with the put option, whatever it is. Now binomial is crystal clear. Up jump is 1.62 20 multiplied by 1.62 20 multiplied by down jump 2861 17.21. Further second note 23.24 multiplied by the up jump of 1.162 and 23.24 multiplied with the down jump of 0.68 and again 17.2 $1 multiplied with the up jump, that is 1.162 and 17.21 multiplied with the down jump, that is 0.861. Easy to understand, nothing binomial, simplest your calculation. It gave me the stock price at different notes. Now using the European option, I have simple to do backward induction. Or first I will calculate the value of call at each node. The value of call at this node is $6. Easy to understand, strike price is 21 rupees, market price is $27 rupees. I will use the option and get a profit of $6. Very easy to understand. At this node, market price is $20 and the strike price is $21. I am out of the money. I will not access the option. So if I am not access the option, my loss is zero, my profit is zero. So value of option is also zero. At this node, again, I'm out of the money. The market price is $14.82 and the strike price is $21. I'm neither in profit nor in loss. I'm out of the money. I will not access the option and the value of option becomes zero. Simple. Now with the backward induction, I have to come here. $6. The probability of going upward is 49.6% with the calculation obviously, and probability of going down is 50.4%. So $6 multiplied by 49.6% plus $0 multiplied by 50.4%, the sum of which further discounted with a discount factor, the value of option this node, that is $2.94. Easy to understand, no confusion. I have to calculate the value of option at this node also. At this node, we have one up movement, one down movement. The value of option of up movement is zero, multiplied by the percentage. Up movement is 49.6%. The value of down movement is zero, multiplied by the probability 4%. The sum of which further multiplied by the discount factor, whatever it give me the value, however the value shall remain same. Zero multiplied by anything shall remain zero. So it give me the value of all option at two nodes. However, I have to calculate the value as on date. So $2.94 further multiply the probability of up movement, that is $49.6, and probability of down movement multiply with the probability of down movement, that is 50.4%. Understand? The sum of which multiply by the discount factor give me a value, that is 1.46. Okay. However, I have to further calculate if any value is here in the down movement. The value is zero, multiply by anything shall remain zero. So the sum of which give me the value of all option here, $1.446. Understand? So, so what we get? We get the we easily understand the call option. In the next slide, I will teach you the calculation of the put option using the binomial option. Give me a time break for 2 minutes. So we have understand the call option using the binomial. Now in this slide, I will teach you the put option. See, all the calculation of the share price, all the calculation shall remain the same. But the question reverse. At the end of the maturity in the European option, I will ask myself whether I will sell in the market or I sell to the co-striker or the contract holder. Understand? The question is whether I buy from the market, reverse, whether I will sell to the market. This is what is my right to sell. I am a put holder. So see, look, in this scenario, the current market price is $50. We understand the parameters. We understand the up jump. We understand the risk-free growth rate. We understand the probability. We understand the we understand the up jump. We understand the down jump. Okay. All the calculation of the share price or the value or the calculation shall remain the same. However, backward reduction, we have to ask the different question which give me the value of call. So let's start with the put option value. The current market price is $50. It has a up jump of 20% and a down jump of 20%. So after a period, I will get $60 here and 20% less $40 here. Okay. At this node, we further move a up jump of $20, 20%, that is $70, and a down jump of $48. Okay. In this node, we also do a up jump of 20%, that is $48, and a down jump of 10%, that is $30. So in a European option, what I will ask at the end of the maturity, using a while calculating a put option, that whether I will sell in the market or I will sell to the put striker. In this scenario, The market price is $72 and a contract price is $52. Strike price is $52. Whether I will sell in the market or I will exercise the option. Obviously, I will sell in the market. Easy. I will sell in the market $70. I will not exercise the put option. The value of the option at this node or my profit, I'm out of the money, is zero. Okay. Again, at this node, I ask the same question to myself whether I will sell in the market or I will sell to the put striker. Obviously, I will sell to the put striker. He gave me $50 and the market give me $48. I will buy from the market $48 and sell to him at $50. It give me a profit of $4. I'm in the money in this scenario. Again, at this node, ask the same question to yourself whether I will sell in the market at $30 or I will sell to the put striker at $50. The answer is I will sell to the put seller at $50. What you will understand while selling the call option and the put option that the seller of the call option or the seller of the put option have unlimited potential of loss and limited potential of profit. His or her profit is only the premium which he received or she received. However, being the buyer of the call option or put option, my profit or my profit is unlimited. However, my loss is only the premium which I have earned. Understand? So what it give me? It give me the value of call option at different nodes. Again, simple. I have to do a backward induction. But what we have done in the calculating the call option, I will do in the put option as well. What is the probability of going to the this node? Is 62.82%. And what is the probability of going to this node? Is 37.18%. This multiplied by 62.8% and this multiplied by 37.18%, the sum of which further multiplied by the discount factor, will give me value of put option at this number. Again, we are using the European option. I will teach you the American option as well. However, the value of my call option at this node is $1.41. Okay. The VSB team can ask the question at any time. Okay. So come to this node. There is the probability of $4, 62.82%, and the probability of $20, 37.18%. 4 multiplied 62.82%, $20 multiplied by 37.81%. The sum of both multiply with the discount factor, give me a value of my put option here, that is $99.46. Easy to understand? Got it? Now again, what we have done in the call option, we have to again read the put option. We need the value of the put option as on date. So the probability of getting the $1.41 is 62.82%. The probability of getting the $9.46 is 37.18%. Easy. $1.41 multiplied by 62.82%, $9.46 multiplied by 37.18%. The sum of both further multiplied by the discount factor. What will give me the value of the put option as on date? That is nothing but $4.193. Using the binomial option, my put price as on date is $4.193. Easy to understand? Very easy to understand. See, Till now, we understand the European option, calculation of European option, while exercising the call option, calculation of European option while exercising the put option. I think both fundamentally clear to you. Now come to the American option. See, this is European option. For further clarification, we can write this as well. Yes, same put option. Easy to understand. Now, what I told you while calculating the American option, what is the difference between American option and the European option? American option give me right or give me an option that I can exercise the option at any node while using the binomial. However, the definition is at any time within a specified period. But in binomial, we have different nodes. So it give me the option to calculate or to exercise the option at each node separately. No confusion. I will teach you how to do it. I will teach you calculation of American put option and calculation American call option. Or call option, you can easily calculate if you understand the put option. The fundamental must be clear. The fundamental what it says. So a simple question before starting the American option is to you that tell me that at any given point of time whether the European option can give me much value than American option or it is equal to the American option. You will understand. See, at any given point of time, my value of American option is always equal to or higher than the European option. How and why? Both will shall be answered in this example. Look carefully. We have parameters, we have inputs. This is a put option. My asset as on date is $50. The up jump is $1.35. Sorry, 1.3.5 and down jump is 0.741. So $50 multiplied by the up jump 1.35 give me value 67.49 and $50 multiplied by the down jump of 0.741 give me a value of 37.04. Forward calculation is same. The difference shall come to the backward introduction in calculating the American option. $67.49 further multiplied by the up jump, that is 1.35, and 67.49 multiplied by the down jump, that is 0.741. Give me a value of $91.11 and $50. Okay. At this node again, I have to multiply with the up jump, that is 1.35, and multiply with the down jump, that is 0.741. Give me the value of $50 and $27.44. This stock calculation is clear. Now come to the calculation of the option value. It is a put option. At each node, I have to ask whether I will sell in the market or I will sell to the contract holder of good. Okay. Here my market price is $91.11 and the contract price is $52. I will not exercise the option. I will sell in the market at high price and the value of the option become 0 at this node. And at this node, the market price is $50, but the contract price is $52. I will simply exercise the option. It will give me a profit of $2. Because I can buy from the market at $50 and sell to the stakeholder at $52. At this node, the market price is $27.44 and the contract price is $52 strike price. So I will simply exercise the option and get a profit of $24.56. Here the calculation both in Europe and both in American is same at the last node. Okay. So what I taught you in the European option, I have to come to this node. We further discount these two values, 0 multiplied by the probability, 51%, and $2 multiplied by the probability of 49%. Further multiply the discount factor, give me a value of 0.93. See here I have to calculate two different options because I can also exercise the option at this level as well. First, I can go further or I can exercise here. The further, if I go further, my current price is 0.93. But what if I can exercise the option right now? Again, I have to ask the same question. The market price is $67.49 and the strike price is $52. Whether I will exercise the option or not, I can't ask the same question in the European at this node because European option gave me the option to exercise at the maturity of the time period. But American option give me the option to exercise at any point of time. At any node, I can exercise the option. So again, I have to ask the same question whether I will sell here at $69.5. I am in the money or out of the money. In this case, I am out of the money. Why? Because the market price of the is much higher than the strike price. I will not exercise the option. I will sell in the market at higher price. It is a put option. So the second profit come to zero. So I have to see whether I have to exercise this or exercise this. What I will do? I will obviously go further and get a profit of $0.93. So the value of American option at this node is $0.93. Easy to understand? No confusion? Now come to this scenario. You will see what is happening. If I go further and exercise $2, what is the probability? 51%. And $24.56. What is the probability? 49%. 2% multiplied by 51% and 24.56% multiplied by the 49%, the sum of which further multiply the discount factor give me a value of $12.42, isn't it? But you ask Mr. Herman, why you have taken the value of $14.96 here? See, this is a scenario changes. In American option, I have to ask at this node whether I will sell in the market at $37.04 or I will exercise the option and sell at $52. So here I'm in the money of $49.6. So what American option gave me two values, $12.42 and $14.96. What I will use the option which is more profitable to me. Now you are getting American option can be higher or equal to the European option. European option shall always be lesser or equal to the American option. Always. Here the American option is higher than the European option at this node. So I will simply do $14.96 is my profit here or the value of option at this node. However, I have to further do a backward induction because I have to get the value of option at current value of option. So 0.93 further discounted with the 51% and $49.6 further discounted with the 49% and sum of which further multiplied by the discount factor give me a value of 7.428%. Sorry, 7.428 dollars. Now, some theory says that while calculating the American option, we have to check whether I'm in the money or out of the money at this node as well, because the American option. And some say that what the backward introduction give me at here, I will exercise the same, that value. However, in my view, we have to calculate the option at this level as well because it is American option. Okay. Again, the more profitable is $7.428 while calculating the put option. So the value of my put option is 7.428 while using the American put option value. Did you understand? No confusion. Very easy binomial. We have separate time with us. So I will teach you American call option as well. The value of call option, the forward calculation of the share price is same. $50 multiplied by the up jump, $50 multiplied by the down jump. Give me the value of $67.49 and $37.04. $67.49 further multiplied by the up jump and further multiplied by the down jump. Give me value of up node $91.11 and down value $50. At this node, further up jump, further down jump, $50 and $27.44. Again, simple question to ask whether exercise or not. I will exercise the call option $91.11 or I will use the strike price and buy from the strike holder at $52. I'm in the money. I'm $39.11 in the money. It is a profitable to exercise the option. Here, at this node, I'm out of the money because the strike price is $50. It is not profitable to buy from the strike holder. It is profitable to buy from the market. So value of option is zero. At this node again, I'm out of the money. So the value of option is zero. Again, I have to ask the same question to myself. Backward induction of American option or European option as well. Nothing much difference. $39.11. What are the chances of $39.11 is 51%. What are the chances of $0 is 49%. The sum of which further multiply by sorry. The sum of which is $18.96. However, I have to recalculate the call option that whether I will exercise $67 here or strike price. I'm in the money, but that in the money is less than the European, less than the money which I get from the future profit. So the current profit is $18.96. Here the both node value is zero. So value is also zero. But again, if I ask the same question to myself at this node, whether I will buy from the market, or I will buy from the stakeholder, I will buy from the market, I'm out of the money. So the value remains zero. Again, I have to further backward induction the American option as well. $18.96 multiplied by the 51% and $0 multiplied by the 49%. The sum of which further multiplied by the discount you fed 940. So what I told you what is option. I told you what is call option, what is put option. I told you what is American option, what is European option. I told you what are the inputs we have to use. I told you how to calculate the volatility. I told you how to calculate the growth rate. I told you how to calculate the probability of up jump. I told you how to calculate the probability of down jump. I told you how to calculate the up jump. I told you how to calculate the down jump. So with these parameters and these inputs, you can create a binomial tree with n number of nodes, n number of nodes, which is simple pen and paper. You need to use the Excel as well. So I hope I have taught you everything what I have learned. So my lecture is over here. I we are ready for the question answer session. Rahul sir, Asta ma'am, is there any question?
We have received few questions, sir, actually. I'm sending it uh,
Yes, sir.
sending it
We
to
will.
the
I will ask all the question at the end at 11:45. Till then, you can continue.
Just hold for a second.
questions actually. I'm sending the question to the answer. Please ask the speaker. So can I send you
Why
directly on the
why
chat?
you taken the why you taken 20%? What is the basis of determining the up move or down move or down move percentage? See, I only told you the basis. Let me again open the slide. See, I told you that in this sheet, I assume 10%. However, while calculating the call option, I teach you the how to calculate the probability of up jump and probability of down jump. Isn't it? The basis is Brownian motion. We take this calculation from the Brownian motion. Again, I think you skip the formulas I taught you for a second. I think you skip the formulas. Let me open the formulas first. See, this is the probability, calculation of probability. I told you that binomial works in a risk-free environment. Binomial works in a risk-free environment. The risk-free my growth. What is my growth? The growth with the value which I what I get from the up movement and the value what I get from the down movement. It is nothing which drive the growth rate, which is a up movement multiplied by the probability of up movement, down movement multiplied by the probability of down movement. Okay, what it give me? It give me the value of up movement. Is the value of probability of up movement. These are the formulas. You can write it down. Okay. Anything else? I hope I solved the question. Rahulji, anything else?
Question. Am I audible?
Yes, ma'am.
The question is explain how the risk neutral probability concept could be integrated in use the insights provided by risk neutral probabilities to make informed decision about portfolio diversification and risk exposure.
Portfolio diversification and risk aversion. These two are you can say the limitation of binomial as well. The risk binomial I again told you I give this slide also. Just hold for a second. Let me open the slide again. See what is for the calculation of growth. Atha ma'am,
Yes, sir.
tell me what for the calculation of growth, what parameters I have. In a risk neutral world, in a risk neutral world, what is what a profit I can get?
Uh, 1 second, sir. Actually, your voice was
Again,
breaking. Can you please repeat?
give me a simple answer. In a risk neutral world, what is the profit I will get at any given point of time? There is no risk.
Yeah.
We are living in this world. We can get only risk-free rate of interest.
Yes.
Okay. So while calculating the binomial, what binomial do? If I risk-free rate, suppose I'm using a multi-column option, I have to multiply with the random numbers. But
Yes.
binomial says specifically that you have to use a scientific approach. Okay, so scientific
Yes.
approach, what I got a Brownian motion. What is the formula for Brownian motion? That random number should be e raised to the power r, risk-free rate.
Yes.
Okay, and any risk-free, any return further reduced by the dividend, which if I have paid anything, the dividend reduce my return,
Yes.
and risk neutral world, the same percentage. So for calculation of the risk neutral probability or risk-free growth rate, I have nothing with me but the risk-free rate. So the formula is which we have derived from e raised to the power r minus q to delta t. Now come to the volatility. See again, volatility is what? How my stock respond to the changes is nothing else. How my risk respond to the changes, and being a valuer, the diversification and the change, the different comparable companies. I have to see which companies are closely related to me while calculating the volatility. This is a different scenario of binomial, but being a valuer is my duty. So the both things are clear to you. The practical
Yes,
term I
sir.
give you the practical term I give you the formula. There is nothing in loose term in binomial. We specifically go with the scientific formula only. Okay. Any further question?
Yeah, there is one more question. That is, in what scenarios might the binomial model be preferred over the Black-Scholes model and vice versa?
See, both models mostly give you the same value. It is a judgment of the value which have to be used. If he is comfortable with the binomial, he can use the binomial. If he is comfortable with the black school, he can use the black school. But if the movement of price is changing drastically with a short period of time, in my view, it is a better to use the black school than binomial. Because binomial, what is binomial doing? It gives you the value at different node at a separate different intervals. Understand? So if the price is not changing readily or price is constant or approximately constant for a period of time, so binomial is good. Otherwise, you can go to the black school. Or you can use the both and take a average of binomial and black school. Or you can also use the Monte Carlo as. Okay, any further question?
Sir, the participant who asked the question about the 20%, why he's getting 20%, is also saying that my question is not about the arithmetical calculation using formula. My question is about 20% and why not 30% or 15%. He's asking the same
See,
question as me.
Mr. Rahul, don't get confused. I think before starting the binomial option, I told you that I will give you all the formulas. But for simple understanding of that particular slide, assume 20%. However, in the next slide, let me open the slide again. Just let me open the slides again. Under no chances you should be confused. Here it is a 20% assumption, I assume. But if you look carefully in this sheet, for I clearly told you how to calculate the probability. Mr. Rahul, is it clear?
Yes, sir.
The calculation is done in this slide. The probability of up movement is A minus down movement divided by A minus down movement divided by up movement minus down movement. The fundamentals have already been clear to you in the PDF file. But for the just for the sake of the convenience, I take the assumption. However, we can calculate the up movement and down movement here as well. Okay.
Okay, sir. After you can ask the question.
Yeah, there is one more question. How does increasing the number of time steps in the binomial tree affect the accuracy of option price estimation?
Sorry. See, there is. See, try to understand. Being a valuer, I have to take example of a private limited company, and number of I have to issue ESOP after a period of 3 years. So my total number of period is 3 years. Understand? Now what I have to see that how many number of iteration I have to check. Here I have to use my judgment. I have to check whether I have to my stock price or the changes in stock is to be done in bi-monthly, sorry, bi-yearly, quarterly, or yearly. In my view, only and only in my view, this is while calculating the non-listed company or private company, I have to take attrition at yearly level because most of the my share prices is come after my balance sheet or my financials have done. However, if the valuer think that no, the share price can be changed after quarter or after half year, so they can take the attrition at that moment. So my total period of ESOP, if it is 3 years, so 3 years. If I check that, if I do the iteration at 1 year, so my total number of iteration is 3. If I use the iteration as half year, my total number of iteration is 6. If I take it quarterly, then when 12. But I can use the monthly as well. It slightly impact my value, but it is a value of judgment at that particular situation or a particular period or a particular scenario. What number of iteration I have to see. See, the fundamental should be clear. Don't confuse with the number of iteration. The binomial should be clear. No matter how many binomial tree it makes, how long binomial tree it makes. But if my fundamental are clear, I know that particular node my value is this. I am in the money or out of the money. Simple, I have to do the backward induction with the discount factor and the probability. Don't confuse with the number of iteration. Okay.
Okay. So next and the last question is, can you provide an example that how violation of the risk neutral pricing principle could lead to arbitrage?
How?
How violations of the risk neutral pricing principle
Correlation.
could lead to arbitrage?
See, arbitration is a different scenario.
Okay, okay.
I simply give you the calculation of the binomial pricing option model. Whether to arbitrage or not to arbitrage is a concept which is on a case specific basis, which is altogether a new lecture. I have to take a new lecture. But if you have a question regarding the binomial only, I can answer that in this scenario. For the purpose of
Okay, sir.
binomial, for the purpose of binomial, our value should be clear about the fundamentals. I give you all the fundamental techniques. Calculation of volatility, calculation of probability, calculation of up jump, down jump, nodes. In that situation, your fundamentals is clear, the binomial is clear.
Thank you, sir, for sharing your expertise with us today. And, am I audible? Because okay.
You're audible.
So thank you for your time and insights. I would like to thank entire audience for their participation and engagement during the session. We hope you found the information presenting here today to be useful and informative. Once again, thank you everyone involved in making this Valuation Manthan series webinar a success. We look forward to seeing you at our next event. Have a great day.